All right, let's talk about Arch Capital. This is a specialty insurer that, by pretty much every measure, is a top-tier performer. But here's the kicker for us as investors. Is the market actually giving them credit for it? Today, we're going to dig in and find out. So here's our game plan. First, we need to understand the wild market Arch has to navigate. Then, we'll pop the hood and see how their business is built. After that, we'll uncover their secret sauce, their competitive advantage. We'll check the scoreboard to see the results. And finally, we'll ask the big question. What's the stock actually worth? Okay, first things first. You can't really get a handle on an insurance company without understanding the world they live in. And for insurers, that world is all about navigating these massive, often brutal market cycles. This is the million-dollar question, right? In the property and casualty insurance world, it's all feast or famine. Winning isn't about just riding the good times. It's about being smart enough to know when to hit the gas and, just as importantly, when to tap the brakes. So you have these hard markets where disasters happen, capital gets scarce, and prices shoot up. That's when the profits are huge. But then that success attracts competition, prices fall, and you enter a soft market where it's tough to make a buck. Right now, we're coming off a really great hard market, but things are starting to normalize, which means the easy money is gone. And what's super interesting about right now is that the market is literally splitting in two. On one side, you have commercial property insurance. Prices there are finally starting to cool off. But on the other side, you've got casualty lines. Think things like liability insurance, and that's a whole different ballgame. Prices there are staying high, mostly because of this one major headache. And that headache is called social inflation. You hear this term all the time. Basically, it just means that lawsuits are getting more frequent and juries are awarding way bigger sums of money. This makes it incredibly hard to predict your costs years down the line, so having real expertise here is a massive, massive advantage. So, in a market this tricky and divided, how does Arch set itself up to win? Well, it all starts with how their business is built. They're not just trying to survive the cycle, they're structured to actually take advantage of it. And this chart really tells the story. Arch isn't a one-trick pony. You can see they're not overly dependent on any single business. They're basically a combination of three different engines, split pretty evenly between their big insurance and reinsurance arms, with a smaller but really critical third piece. So you've got the insurance business, the reinsurance business, and then what I kind of think of as their secret weapon, mortgage insurance. Now, while the first two ride that classic insurance cycle, the mortgage business moves to a completely different beat. It's tied to things like the housing market. This gives them this amazing, steady stream of earnings that often zigs when the rest of the P&C market zags. Okay, so having three engines is smart. But Arch's real advantage, its competitive moat, as investors like to call it, is all about how they run those engines. This is what really separates the great from the just plain good. This right here is the heart and soul of their strategy. They are masters of cycle management. When prices are high and the deals are good, they write a ton of business. But the moment the market gets soft and undisciplined, they pull way back. They absolutely refuse to chase growth just for the sake of it. They only chase profits. And this quote from management, it says everything about their culture. It's about being conservative. In insurance, it's easy to look good in the short term by not setting aside enough money for future claims, but that can blow you up down the road. Arch does the opposite, and that protects the company and its shareholders for the long haul. So you see, the moat isn't just one thing. It's these four pieces locked together. You've got a culture that pays for profit, not volume. You've got the diversified business model. You've got deep expertise in really tricky niche areas, and it's all built on a rock-solid AAA-rated balance sheet that gives clients total confidence. A great strategy and a strong moat are nice to talk about, but do they actually produce results? Let's find out. This is where the rubber meets the road, and we see if this whole approach actually creates value for shareholders. And boom, there it is, 15%. That's the rate they've grown their book value per share every year. For an insurer, book value is the best measure of its intrinsic worth. So to consistently compound that value at 15% in a crazy cyclical industry, well, that's just a sign of incredible discipline and execution. And you can see that 15% isn't just a made-up number. Here's the journey. Sure, there was a little dip in 2022. That's insurance for you. But the overall trend is powerfully up. Just look at that massive jump over the last couple of years when their strategy really paid off in the hard market. So what's fueling that incredible growth? This number, elite profitability. An operating return on equity of nearly 19% is frankly world-class in this business. It shows they aren't just getting bigger. They are deploying capital with incredible efficiency and earning returns way, way above their cost of capital. Okay, so we've established they're a fantastic company, but that brings us to the most important question for any of us. What's all this performance worth? Because a great company can be a lousy stock if you pay too much for it. First, let's just be crystal clear. Arch performs with the best of the best. Their profitability is right there with W.R. Berkley, another legendary company in the space. And they are crushing their average competitor. By this measure, they're in the absolute top tier. But then, you look at this. And this is where it gets really, really interesting for an investor. Despite that elite performance, the market gives Arch a much lower valuation than its top peer. W.R. Berkley trades for almost 3 times its book value. Arch, only 1.6 times. That is a massive disconnect. And that right there is the whole puzzle. You have a company that generates A-plus returns, but it's trading at a B-plus price. So you have to ask, what is the market worried about? Is there some hidden risk we're missing? Or is this a genuine opportunity to buy a great business at a reasonable price? So it all boils down to this. On one hand, you have the proven strengths, their incredible discipline, their smart business mix, and a long history of making shareholders richer. On the other hand, you have the real risks of this industry. The cycle is turning down, a huge hurricane could always hit, and there's always a bit of guesswork in what you'll owe on claims years from now. And that leaves us with a final question, the one you have to answer for yourself. As the tailwinds for the whole industry start to fade, is the market making a mistake by lumping a disciplined compounder like Arch in with everyone else? Or are they right to be cautious? That's the bet you make when you buy the stock.